Delighted that you could join us today. This is the first time ever IFI Global has done a combined online and in-person event. Some of you will know we do an awful lot of online events, and we also do a lot of in-person events. In fact, and this is the third time I think we've been in New York this year, for example, for an in-person event. But as I say, it's the first time we've tried to combine the two at the same time. If it all goes wrong, we will have a recording of this, and you will be able to, this is for the online audience, or indeed for the physical audience, you'll be able to listen to that. And we will also have an article published in one of our publications on this discussion today. We really want to have an online option for this discussion because there is a lot of interest in these SEC rule changes around the world. And we have, I think, if everyone shows up, we have something like 153 people who've registered to follow this discussion today. A little bit over half of them are in other countries around the world. Welcome to you if you're joining us, and a little bit less than half are here in the US. So welcome to you all, both in the room here and wherever you may be in the world. For those of you who don't know IFI Global, which will be a lot of you, we are a research and media organization based in the City of London. On our media side, we have 4 publications, and 2 of which will be following these SEC rule changes very closely indeed. One of them is our fund governance publication called The Ned, and another one is FSI, which is for US managers either looking to go offshore or come to Europe. And in this month's FSI, we're launching a thing called the Fund Servicing Tracker, which, as well as recording what US managers are doing in terms of their fund structures, will also be recording their distribution options, service provider selections, and perhaps domicile selections too. So thank you very much again for joining me, and particularly thanks to Jersey Finance for sponsoring this event today. I'm now going to ask Elliot Revson from Jersey Finance to say a few words of introduction, and then we are going to get into the panel. So Elliot.
Good morning and welcome. Thank you for taking the time to join us either in person or online. As Simon said, my name's Elliot Revson, and I head up the funds area at Jersey Finance. Jersey Finance is the promotional body for the finance industry in the jurisdiction of Jersey. A part of my role is to work with our government, regulator, and industry to help shape the product offering of Jersey PLC. And a part of my job is to tell people what that actually is. We use these events that we sponsor with IFI in the United States and many others around the world, both as thought leadership and to take the pulse of the market, to hopefully disseminate information, but to learn also from the industry. This year, also in New York, we focused on the digitalization of real assets, overviewed European access to US managers who are increasingly looking to raise assets overseas. And in this session, we'll look at the SEC's private fund advisor rules and what they mean for onshore and offshore managers. Whilst recently instigated by the SEC here in the US, these rules are already being looked at by regulators around the world. From a Jersey perspective, our greatest strength is the ability to offer stability, political stability, fiscal stability, and regulatory stability. And as well, one of our key strengths is in governance, which is a large part of the focus here. But in many ways, these issues raised by the SEC's private fund advisor rules are not new. The hedge fund community has provided a far greater level of transparency over private markets for many years. To me, 2 of the key implications of these rules that I see will be based on the reaction of the investors, whom to date have estimated the value of their investments in these markets, and the implications of that, especially where valuations differ significantly. And also, the investors will, for the first time, have insight into their own and the terms agreed with other investors. I'm interested to hear the views of the panel in this regard, as well as their other insights. And with that, let me pass you back to Simon, who will moderate the session. Thank you.
Thanks. Okay, we're going to get straight into it, and I'm going to introduce the panel. On my immediate left, we have Chris Addy, who is the founder and CEO of Castle Hall, which is an ODD firm for investors, not only in the US and Canada, but around the world. Chris is based in Montreal and is Canadian, but he does a passably good English accent, particularly if you like a bit of Yorkshire in your English accent. Sitting on my furthest left is Sean Wilkie, who's Senior Managing Director and Head of Growth at IQEQ. And on my furthest right, we have Philip Pericki, who is America's Head at Jersey Finance. And sitting next to him is Michael Johnson, who's Senior Lead Partner, Alternative Investments at KPMG. And on my immediate right, we have Eileen Overbar, who is a partner at Schulte, Roth and Zabel. So we have an investor, we have a consultant, we have a lawyer, we have someone from an international fund jurisdiction, and we have a service provider. We have a deliberately very different eclectic panel here representing all the different parts, constituent parts of the industry. So I think we should get straight into the first question. And I'd like you all, if you wouldn't mind, to have a go at answering that. Eileen, can I come to you first? And the first question I want to ask is, what are the implications of the SEC's private fund advisor rules for the industry, both those that will almost certainly stay, as well as those that might get chalked off if the litigation, which we're doubtless going to get into in a few minutes, is successful?
I thought we were headed into a joke there. The accounting on
the desert bar or desert island.
So in my mind, there will be a number of unintended consequences of this rule, of these rules, really, things that none of us, and certainly the SEC, didn't really expect. That may be pushback for investor requests, whether that's in ODD or side letter requests, right? Where the SEC thinks that this may have provided greater transparency, more protection for investors, and they actually have the reverse effect, right? Where managers pull back a little bit and feel that they can't share things with certain investors and not others because it would be violative of the rule. I think also, and especially important to what I do in working with emerging managers, this may actually really reshape the landscape of seed investing and anchor investing.
All right.
And that could be transformative for the industry, possibly in a negative way, right? Perhaps fewer emerging managers and fewer new startups, right? And that is not necessarily a good thing, right? New blood and competition in the industry typically is good for asset management and as a result, the investors. So if we see either of those things happen, I think it will actually be very much unintended and not a positive thing for investors.
Thank you. I'm going to go to my immediate left now and ask Chris Addy to answer that same question with my high-tech squiggle thing on my laptop here going on.
I was thinking
very high-tech.
Have one of those AI things that follow your face. So I mean, I think I would start my comment by just actually putting this into a little bit more of a historical perspective almost. I first came involved in hedge funds as a newly qualified British accountant who moved to Bermuda. That was a hardship posting in 1994. Bank of Bermuda was still the world's largest hedge fund administrator. And really at that point, you saw hedge funds were the secret club of the super rich. You saw them in the islands, in the Caribbean and in Geneva. And in my mind, if the industry remained an area which was dominated by ultra high net worth individuals, then that really is a situation where it is private negotiations where all individuals can negotiate as they see fit in the privacy of their own organizations. What has changed, however, is the fundamental explosive growth of both hedge funds and private equity due to the introduction of pension capital. And despite the English/Yorkshire accent, I am based in Canada. And obviously some of the world's largest pension investors, think Canada Pension Plan Investment Board, Ontario Teachers, public sector pensions, are in Canada, and they collectively represent tens of millions of end pension investors. We're also very active in Australia, where the superannuation industry is $3 trillion, is equally one of the world's largest pools of capital, and again represents the 28 million Australian individuals. So I think what we have here is really a set of rules and regulations which are changing the dynamic of alternative asset investing. And what the SEC has focused in is particularly, they use the phrase contrary to the public interest and protection of investors throughout the document. And what they are highlighting as the three foundational pillars of why they believe that regulation is appropriate and justified is to say that firstly, there is a lack of transparency in alternative assets. Secondly, there are conflicts of interest. And thirdly, there is deficient governance. And I see multiple governance professionals and also a tough crowd of ODD practitioners who are going to hold me to account if I go off the rails here. But I think the industry has changed. And I'd make one final comment in that we are now coming off, since the global financial crisis, the GFC of 2008, it's been, I heard it described recently as the cheap money decade. It was almost a cheap 15 years. I've heard it described as ZIRP, zero interest rate policy. Actually, the best one I saw in a paper recently issued by the Standards Board for Alternative Investments that's called it the Goldilocks decade. We clearly have had a period which has been very favorable to returns and performance of strategies that have been dependent and able to take advantage of very cheap or essentially free leverage financing. Clearly, we are now in a very different domain looking forward with very concerning issues around valuation, around expenses, around a range of other due diligence and broader investment topics. So I think my overall flavor here as I think about this, first of all, the industry has fundamentally changed. I personally could see a lot of merits in having two sets of rules. You know, if you want to be a hedge fund or a private equity or a VC that just wants to deal with ultra high net worth individuals, 50 million or up or 100 million and up, then fine. But once we are involving end pensioners, we are fiduciaries, and the investors are simply gatekeepers and intermediaries between the asset manager and the pool of capital that's being used to pay beneficiaries meet those pension obligations. And I secondly think that we are entering a very interesting time in the industry. We've had a period where things have generally gone well. One of the first rules of due diligence is no one asks tough questions when everybody's making money. We are now moving into a different environment where diligence issues around conflicts, transparency, and governance are going to be much more significant. And I think the SEC has really come on point with a lot of the residual inherent issues that have been frustrating to investors over this period. That's not to say, of course, that nothing's perfect. Every rule can be improved. There are going to be unintended consequences. So it's going to be great to explore both sides of that.
Thank you very much. And I think on my going left, right, or right, left, I'm going to go to you now, Michael, if I may, with the same question, with my high-tech swivel, to see whether this works.
Sure.
So that far out.
Good morning, everybody. It's great to be here. So a little bit about our practice at KPMG. We run the entire ecosystem of investments that includes source asset owners, like Chris's clients, the pension funds, other types of financial institutions, high net worth family offices. That's one end of the spectrum. The managers are on the other end of the spectrum, and the intermediaries in between. So we have clients all across all of it. And what we deal with is the practical implications of regulatory change of any kind. And so we're listening to our clients. We're trying to help them understand how to navigate these practical implications. And when you think about the potential impact of the private fund rules, I'm going to ask you to not just limit your lens around private fund rules, but take a look at all of the regulatory change that's happening here in the United States and in Europe that is impacting private fund managers. And they are extensive, increasing Form PF requirements, short stale reporting. I mean, the list goes on. And so if we think about the practical implications of all of those things, firstly, costs of running this business are absolutely going up. And we went through this during the post-global financial crisis, where there was a wave of new regulatory requirements for PF, et cetera, that were new. And clearly the costs have gone up, and the break-even point for the assets that you have to manage went up significantly then. That number is going up even higher now. So you definitely have increased costs to run the business. There's a distraction on management teams. Complying with all of these things, these new requirements, becomes a distraction away from their core talent, which is generating investment returns. And our investor clients are very concerned, once again, about that distraction and what is the potential impact on the management of the organization. To Eileen's point, fundraising is clearly going to be challenged. The pension funds, the large institutional investors, they have armies of people helping them invest in these funds and performing due diligence and driving their own level of transparency. But when the SEC is what they're trying to do, is they're trying to move the fee terms down to the lowest common denominator, what they're actually doing is making it more difficult to raise money. For example, if you have a new manager, and a big important part of our practice is the entrepreneurial side of this industry, in addition to the institutions, but if you have a new manager, a new fund launch, and somebody, a seed investor, wants to come in and get favorable terms because they're taking a risk on that new business, that new talent, that seems logical that they would be able to have different fee terms than people that come in later. Well, all that's going to be gone, or at the very least, you have to tell everybody the terms that person has, and everybody has to get the same terms. So you're going to absolutely challenge fundraising. You're going to quell entrepreneurialism because of the increase in cost and more challenging fundraising environment. And clearly there's an expansion of the jurisdiction of the SEC beyond just registered investment advisors. They've now opened the regulations to private funds, broadly defined, core institutional investors, broadly defined, and that's brand new. So whatever happened to the neighborhood investment club, or a handful of friends that want to get together and pool their money and invest in real estate property? Well, all of a sudden that could potentially be pulled into SEC compliance, and it's going to become a disincentive for those investment clubs, those smaller groups to come together. And so that's one of the things that I found most interesting is it's not just about registered investment advisory anymore. And so I think I hit my list. I could go on and on, but I'll
thank you. What I like about these opening comments is there's so many different ways we can go to that punch up I'm hoping to have a bit later here. Sean, if the two guys on the end I deliberately placed because I think they've got nice loud voices, so hopefully the online audience will be able to hear you. Your response to that same question, if you don't mind.
Yeah.
And if we can see you. I think we can just do that.
I think the law of unintended consequences is a good way of looking at this. And kind of to Michael and Eileen's point, who are the new regulations actually protecting? Is it the mass affluent investors that come into a fund with $1 million or something like that? That's a group that's been largely ignored, right? You're either looking for the pensions or, the mom and pops that are usually investing in the mutual fund industry. The large institutional investors and allocators, they tend to have deep pockets, can hire investment consultants, they can negotiate for themselves. So, I really just don't, now we can parse through the specific regulations. I think some of them have more merit than others, but I think at the end of the day, compliance with the lion's share of the new regulations, assuming that they hold up in court, which I think the vast majority of them will, is going to significantly.
Excuse me, when you say hold up in court, which way round is it going to hold up in court? I think clarification, and also for the online audience that won't be as familiar with the litigation, which we will get into, if you could just say which way you think it will go very quickly and then carry on.
Well, I'll preface this with I'm a recovering lawyer and by no means a constitutional or administrative law scholar. My assumption is that I I think there will be a slightly scaled back version that will end up becoming law at the end of the day. Now, the timing also is a bit precarious. Nothing moves quickly in court. So whether that comes into effect before or after the compliance date, maybe that is yet to be seen. I do think the safeguarding of assets and the true investor protection provisions will hold up. I think some of the prohibitions, or at least curtailments, on preferential treatment, we may see some redacted form of what's been published now. But again, I mean, this is pure speculation. I'm certainly not the right one.
Sorry to interrupt you there. It's for those that aren't familiar with it. So your line was, this will hold up, basically, by and large.
Correct. Yes, I think it will. But I mean, I think it's going to add to the overhead costs to launch a fund. And I now think that, to Michael's point, the cost of entry into the U.S. market is going to be driven up significantly. And we see this in Europe. There's been massive consolidation, and that emerging and lower middle market of fund managers just doesn't exist. Right? You basically have massive consolidation. You don't have sub-billion-dollar funds in Europe by and large. And that's what, that entrepreneurial aspect of being able to launch a fund with a few $100,000 or so in the US, I think that's going to start to go away and erode. And I think we'll see consolidation, or people just, some of these more hub and spoke operations, or the aggregators will start to pick up some of these funds and do, seed investments, or take a percentage of the management company, things like that. So I think there will be a fundamental shift overall.
I think you're already starting to see some of that happen.
Thank you. And Philip, sorry to have you down at the end, but I think we cancelled. Fantastic. Hopefully the online audience can see you there. Can I ask you for your initial thoughts on this?
Well, I get the advantage of actually hearing everyone else go ahead of me, so that works out really well for me. But my purpose on the panel really is to take a view from a jurisdiction's perspective. And Elliot kind of hit this point, actually said it literally in his opening comments. One of the things that from a jurisdictional perspective is, can you adapt and absorb these rules? And the pace of regulation, I think it's been addressed here so far, is actually increasing. So you don't just have more regulation coming, you have the pace of that regulation is happening faster and faster. So jurisdictions need to be able to digest, they need to be able to adjust and then adapt to these new rules. So the actual human infrastructure in jurisdictions matters more and more. You need to have predictability and stability in jurisdictions so that when you're structuring there, you can rely on it. So when I look at it from this perspective, particularly from a governance perspective, now I'm looking at a jurisdiction where you actually have a long line, a long history of expertise, particularly in areas of like private assets or real assets. Now it starts making it, those are differentiators. What will the impact of this particular set of rules be? Well, they're going to be significant. They're already happening. I'm going to be a little bit off on the timing, but about a month ago, the FCA in the United Kingdom came out with its own take on this. If I wanted something analogous, FATCA and CRS, right? You had FATCA pushed forward. It was a massive change to the industry or globally, then CRS followed. I don't see this changing. Chris made this point earlier, which was the institution change or the industry change. It was ultra high net worth. It was a cottage industry. When I launched my first funds, it was still a cottage industry, and it migrated towards institutional capital. It's just a different industry where it is today. And Eileen, you're right too. This will have, ironically, greater systemic risk to the industry because we're going to have fewer and fewer managers. If you go back pre-GFC, the world was awash with small funds, wildly distributed risk profile. Well, I mean, let's face it, that's what these vehicles are, right? They're risk management vehicles. So you have wide distribution of risk. Post, you have massive consolidation because the costs of running these businesses are significantly higher. Your starting capital needs to be significantly higher. So yes, ironically, you probably have greater systemic risk. But that doesn't change the fact that the industry is just different now, and there are different demands for people. So if you're, again, from a jurisdictional perspective, if you're looking for a place to structure, you need to be very clear about, does this institution not only meet my needs today, or this jurisdiction meet my needs today, will it be able to meet the needs 5 years from now, when just the wave of regulation just will keep increasing?
Very good point. Thank you very much. And I forgot to say in my introduction, we do very much welcome questions, both from those of you here in the room and those of you who are online. If you would like to ask a question, if you're in the room, just put your hand up. We'll try and come to you as we go along. We may also reserve a few minutes at the end for questions, but don't necessarily wait. If there's something someone has just said at that particular moment that you would like to challenge or have some more detail on, put your hand up. And the same applies to the online audience. If you'd like to use the Q&A button on the bottom of the screen, do that. We'll try and come to you. We won't necessarily always be able to do it, but we'll try and come to you. And if we get a bunch of questions, particularly from the online audience, I'll try and reserve a few minutes at the end just, so we can keep the flow going. So on to the second question. Chris, I'm going to come to you first on this. Chris and I
had... setting me up at all.
No, not at all. Chris and I had a very good prep session in a pub in London a few weeks ago.
No, an official business location.
An official business location where they had beer. And here's the question. Why did the SEC decide to do this? And has it opened Pandora's box? Even if Sean is wrong, and the litigation, which is coming strangely enough, I think it's from Texas, isn't that right? Texas. Let's say it's all successful. And let's also say, hypothetically speaking, that's all drags on, and all these things always do drag on. And let's say there is a Republican president taking over the White House in late January of, was it 2025? So this won't be finished by then by any means. And he or she, if it's Nikki Haley, it's a she, decides to reverse all this. Has Pandora's box been opened, not just here in the US, but in Canada and in Australia and in the UK and everywhere else where there are institutional investors in alternatives?
It's such a broad-ranging topic, but the overall trend, as this ultimately is a public policy question. And it's a public policy question about demographics with aging populations. And it's a public policy question about the provision of pensions to elderly citizens in Western societies where the average age increases. I think actually the most interesting set of regulation around the world that I'm aware of, and I'm an accountant, not an attorney, so I know even less on this, is actually Australia. Australia is now a $3 trillion industry in superannuation, as I've just mentioned. The regulator there, APRA, the Australian Prudential Regulatory Authority, has been pushing for material consolidation of super funds. There were about 200 for-profit member super funds less than a decade ago. Now it's about 60. The very largest, Australian Super, Aussie Super, Australian Retirement Trust, CBUS, they are all at the $100 to $250 billion level. These are very significant organizations. And that is because of the centrality of delivering pension outcomes for an aging, developed economy population. What the Aussies have done is regulate the investors. They're not actually regulating the managers. Well, managers are caught within ASIC and things of that nature. They are saying, as an investor, you have to establish investment governance and you have to establish an operating model which is sufficient to meet your fiduciary duties and to protect the assets of the end beneficiaries. The money belongs to the pensioners. And what they are doing in that is something called CPS 230. That actually states that the pet super fund has to consider their supply chain, their outsourcing, and they actually consider that investment managers are service providers to the fund. So the obligation in Australia is to conduct service provider vendor due diligence as part of the supply chain. And it really moves away, I think, from a little bit of the the cult of intellect that we all have for being such great investors. Ultimately, these are businesses. It's just that what comes out of the factory door is investment performance, not a widget, as we think through these things. So in terms the overall regulatory trend, there are similar rules in, we mentioned the FCA, the same thing with European Banking Association. There is an inexorable regulatory trend here. And I think that 2 or 3 things are going to come out of this. I think one of the most important things is going to be focus on fees and expenses. And I think people, once they actually aggregate the total cost, and I'm sure we can expand on this later in the discussion, I think investors are going to be very surprised at the aggregate amount of fees that have been paid and consequent once we look through the different levels. And I think there's going to be quite a lot of pushback on that area.
Sorry, can you just give, without naming names, can you give an example of what you're talking about?
Yeah, sure. So, I mean, if I'm a large pension investor and I'm invested in 280 external funds, for example, the first thing I would do if I was on the board of trustees is require my operations team to gather these new quarterly statements and work out how much my members have paid across the now granular requirement of fees and expenses. Getting transparency around fees and expenses is I think, one of the biggest concerns and frustrations of investors. You have to negotiate individually through LPAs. Some people use the ULPA fee template. Financial statements do not provide adequate disclosure. I actually pulled up a statistic from Castle Hall. We looked at 4,727 sets of financial statements at December 31st, 2022. That's the collective footprint of our clients. And 68% of them, 3,216, just show other expenses. You don't know what's in there.
So is that going to change?
Yes, because
is this Pandora's box?
This is one side of Pandora's box. So what will happen is the SEC are very clear that you're going to have to list every single category. So what I would do if I'm a trustee of a pension fund and I have fiduciary responsibility and I could be called before a parliamentary or a congressional committee if anything goes wrong, I'm the one who's got the problem. I'm going to say, right, go across all those 280 funds and find out how much I've spent. And if it turns out that my members have spent $9.7 million on private jet travel to support the marketing costs of a bunch of GPs raising mega funds, that's going to be one side of Pandora's box. The other side of Pandora's box, and now I'll get a little bit more anecdotal and National Enquirer around this, and we're going to have a great discussion about side letters later on. But 2 things are going to happen on side letters. First of all, the average investor is going to be shocked and stunned at some of the stuff that the very biggest investors have put through on this. And then I think the second thing is that the very biggest investors, so there's about 50 that have more than $200 billion, they all think they negotiate better than each other. And there is going to be the cat fight to end all cat fights when ADIA figures out that they've been outdone by GIC in Singapore, and then it turns out the Qataris got one over all of them by putting in some ability to pool a set of London real estate assets and use that as collateral against one of their other portfolios. It's a very sophisticated industry, but again, what are the SEC after? Transparency, conflicts, and governance. That's what they're saying has been the problem, and that's what they're trying to achieve.
Thank you. I rather than saying specifically Michael or Eileen, anyone want to come back to challenge that? I'm flicking this way, assuming that there'll be someone on this side. Do you want?
I have a bit of a different view. And if you listen to Gary Gensler speak, first he telegraphed the fact that this was coming. And he's also been very clear as to his view as to why all of this is necessary. I agree with some of what Chris said, but I disagree on several points. And just as an example, what's interesting to me is that when you listen to him speak and some of his proxies or direct reports in the SEC, they always start talking about the underlying investor and the risk to the underlying investor. The teacher in the state of Louisiana, for example. Love teachers. I married one. My mother was a teacher, right? But the reality is they ignore this fantastic intermediary, and that's this very sophisticated, very wealthy pension fund shop that's surrounded by advisors like us here on stage that facilitates this investor protection that drives transparency, that negotiates very good deals with some of the greatest asset managers in the world. And so, to me, I don't want to get caught up in, oh, this is about the teacher in the state of Louisiana. It really is about these very sophisticated organizations. And he's also channeled his views. He feels these fund managers make too much money in America. That's crazy. You make too much money. There are too many of you. You're not transparent. Okay, in certain respects, fair. And this industry is systemically risky. I think about that one too. So part of the Form PF reporting that I simply just don't understand and our clients agree is if somebody takes a controlling interest in a private company or private entity, all of a sudden that's considered systemically risky and you have to report that to the government within 72 hours. Do the investors really, I mean, you're paying them to make those investments. You want them to make those investments. And this is crystal clear, it's risk-based capital. And so to me, why are they doing this? You know, there is a slice of investor protection there, but they just don't like this industry for the reasons why I stated. And to me, it's very obvious.
Yeah, and I would add that there are other flaws in the narrative that the SEC has developed, and I think some of what Chris is echoing. I mean, on the expenses, the presumption is that the way you described it, Chris, is that those expenses are inappropriate somehow. But maybe the private jet that could have been negotiated away. It's the first line item on a comment memo, right? You take it out. And these investors know that. But if it's diligencing an underlying investment, if it's attending board meetings, if it's paying for the best accountants to be involved at the deal level, those are all really appropriate expenses. We should be spending money on those things. There should not be a race to the bottom on expenses to the detriment of the portfolio. I think oh, sorry, yeah, and just the other point, and I think the SEC really missed this in the final rule. It ignores the MFN process, where they talk about it.
MFN?
Yes, so the most favored nations provisions, right? The biggest, most sophisticated investors always negotiate for that. They want the best deal that the manager is giving. Now, there are some requirements. Often you have to be at the same sizing. A $10 million investor doesn't get the same as the $100 million investor. Sometimes there's a timing component. The first in the door, the seed investor gets the best deal, etc. But that has existed for as long as this industry has existed. You could contract to ensure that you receive the best deal and that the other pension plan would compete with you, right? Some levers could be pulled there, but there was always this protection for investors. The SEC really missed that. And I think it's gotten lost in this narrative.
So, I mean, just on that, the 10 versus 100, I think that probably might sit at the heart of maybe the sort of passion behind it, if you will, in that the 100 million investor, they're going to be taken care of. But the 10 million investor is going to be eating the costs in some places that other investors aren't eating. And I think that's probably one of a lot of things get pushed down. The further you are down on that chain, you bear more of the weight of these, let's call it decisions, commercial decisions, because someone has to pay these costs. So you have a heavier burden on a smaller investor who isn't able to have the protection that they would have had because they have an army of sophisticated intermediaries. But there's actually, I wanted to come back to a point, sorry, Chris, you made earlier, is you mentioned Australia as a great example of this trend. Is it fair to say, and I'm going to go slightly off topic, but if the EU securitization regulations are similar in that they put the onus on the investor rather than the manager who might be promoting a vehicle into the jurisdiction? So is this a trend is what I'm really asking, where you're actually the regulation is going to sit on the investor rather than the manager? Is that a trend?
I think that is really going to depend on the jurisdiction. Australia is at one end of the spectrum because the superannuation industry is, first of all, pervasive. It's mandatory on every Australian citizen. It's not like an optional 401k or an employer's pension scheme or a government plan in a certain state. It's on everybody in the industry, and there's one central regulator, APRA. In Canada, we have no pension regulator. There's no equivalent of APRA. Ontario Teachers is an employer scheme, but CPPIB, PSB are federal. AIMCO, British Columbia are provincial. It's a patchwork of rules. So I don't think in jurisdictions where there is a dispersed regulatory mosaic, it's very unlikely, it's less likely that we'd go in that direction. But I think it is more likely when we have centralized rulemaking, such as we have in the EU or other jurisdictions such as Australia. I did just want to pick up on one point here about that the sophisticated investor can take care of themselves. I'm not sure, I presume most of us are familiar with ILPA, the Institutional Limited Partner Association. They published this, which is called The Future of Private Equity Regulation, Insight into the Limited Partner Experience in the SEC's Proposed Private Fund Advisors Rule. And this is a formal comment that was submitted to the SEC. And it is a fascinating read, because it just really starts to unpick. Remember the Madoff economy, where there was so many people making so much money off Madoff that no one asked questions? This is the private equity economy, where everybody is getting fees, etc. And it's fascinating what they say. They've surveyed many of the world's largest LPs. So this really is the view of the institutional limited partners. And this graph is particularly interesting. This is: the private equity industry has been characterized in recent years by the investors' ability to use their expertise and negotiating leverage to achieve favorable changes in common contractual terms. So this is asking, do you agree or disagree with the view that large investors can negotiate through their own internal resources and then the sphere of external professional advisors that they can bring to bear? And obviously that's a pretty clear graph that it goes in one direction. It's strongly disagree, neutral, agree, and strongly agree. Only 8% of investors surveyed believe that their size is allowing them to consistently achieve favorable changes in common contractual terms. And it is really interesting, what comes through here. We're saying that, first of all, counsel is appointed by the GP, and the starting point of negotiations is a GP favorable document. 97% of LPs have said that the starting point has shifted in GP favor. They are then saying that the time scale given to negotiate is very short. And then there are issues whereby the counsel representing the GP has sight of all investors and all of their negotiations, whereas an LP only has sight of their own set of rules. And it's particularly interesting, ILPA essentially accuses the legal industry of saying that if a law firm has represented 50 GPs over the past few years, and the same large sovereign investor has invested in 15 of those, then the counsel is aware of what that limited partner, that investor, has agreed to back on Fund 13 run by somebody else. So they know the landscape of negotiation, and yet ILPA are extremely critical and evidently very frustrated by the fact that they are stating that LPs can be accused of legal collusion the moment there is an attempt by LPs to talk to each other and combine their legal negotiating issues. But I think that is a very interesting set of fact patterns that does come into the overall discussion here. Again, only 8% of institutional investors are agreeing with the statement that they are individually capable and successfully achieving the outcomes that they would desire. A big theme here is that ultimately you've got to give up on the minor stuff to have any chance of getting the real big ticket items in the agreement. And it's then rinse and repeat. You spend all the money and the time on that one. We get to the next big fundraise, and we're exactly back at square one, going through the same process again. And the SEC has seen this. There are 20,000 registered investment advisors in the world. They've probably inspected 5,000 of them, a quarter of them, over the past few years. They've done deep forensic reviews. They've seen all these side letters. They know where the skeletons are buried. And I think this comes through as to really a back thought of what they are looking for here.
Thank you very much. By the way, I'm going to repeat, both for the sake of the online audience and for the physical one here in the room. We haven't had any questions yet. Please don't be shy. Those of you in the room, just put your hand up if you want to come in. And as I say, for those of you online, just use the Q&A button if you would like to ask a question. Sean, I'd like to try and make this global, because we've got a lot of people, as I said earlier, in different parts of the world. And IQEQ is obviously a global company. Do you think, obviously, what we're talking about here is the SEC and the United States, but of course, 80% of the alternative business is based here in the US or something like that. Have you had discussions at IQEQ about what this will mean for the rest of the world? Chris has been talking about Australia, Canada, and all these other countries. There's no reason why, just because the US is doing this, that the rest of the world is going to have to follow suit. Or do you think it will be the case that the rest of the world will have to, if these rules are implemented anything along the lines that's been proposed by the SEC, do you think the rest of the world is going to follow?
Yeah, it's a good question. I mean, I think generally speaking, the US lags the rest of the world in terms of how intrusive their regulations are. And that's probably the reason why 80% of alternative assets, there's some nexus to the US. Now that this is kind of we'll call it the first of its kind in terms of global regulation that addresses some of these points, I think there's absolutely going to be a cascading effect, which is similar to what we saw with like Annex 4 and Form PF, which, you know, I don't know exactly what we're looking to accomplish. You know, Form PF is a perfect example as to how, you know, two like similarly situated managers can do completely different calculations when they're you know, putting together their Form PF inputs. I think the same type of, we'll call it manipulation, happens on performance calculations all the time. I think we've seen subscription lines of credit being used to managers' advantage for quite a long time. And sometimes I was actually directed by, you know, the underlying LPs that want to make themselves look good so that they can report up to the board, right? So that's, I mean, how that bonus is calculated. Exactly. So I mean, there's incentive on both sides of the table. You know, I think one thing that kind of goes by the wayside here is that we have a regulated investment structure in the US with all this transparency, with equal investment terms, with, you know, different share classes that investors are treated the same way. They're called mutual funds. And, you know, private funds are privately negotiated deals. And, you know, at the root of it really comes down to contractual negotiations and people's right to contract. And I think what gets ignored here is that many institutional advisors or institutional allocators bring a strategic benefit to coming into a fund, right? If you're dealing with the sovereigns, who I can tell you, they get the most preferential terms on the planet because they have $1 trillion worth of dry powder, where, you know, if a fund manager brings them in for a $10 billion fund, they want to invest in a $20 billion deal, they can say, hey, can you come in on a co-investment or direct investment, no fee, no carry, whatever. But it greatly expands the potential investable universe that they can look at. And you want to know what that benefits the fund as a whole, whether you have $10 million in the fund or 100. So I think that largely gets ignored. And, you know, I think managers are ultimately going to suffer, and then LPs are going to suffer because, you know, that type of treatment, that benefit gets ignored.
And those large sovereigns also tend to use the same offers and get the benefit of their knowledge across the industry as well. So it works both ways.
We do have finally some questions. I'm going to read out both of them. Why not? To what extent will firms that give LPs a revenue share in its management company level need to disclose that or other economic arrangements to LPs in their funds below? And the other question is, will there be sufficient disclosure if things are included in the PPM in the risk factors? Anyone want to take that? Or both of them, one of them?
I'm happy to take the first part. So to the extent there are preferential economics that would have to be disclosed, purely disclosure. If it's linked to liquidity, then the liquidity falls into the restricted activity bucket. You'd have to consider whether there was reasonably likely to be a material negative effect on the pool, et cetera, to get to a place where you could give that liquidity. So it's mainly a disclosure issue if we were talking about purely a revenue share in exchange for nothing else. risk factors, I don't know, and I'd be interested in hearing maybe, Sean, your thoughts on this. I don't think that's how this is going to look like in terms of disclosure. I think it may be more of a list or a chart or something like that that ultimately outlines what preferential terms have been given.
Yeah, I agree. I think it's going to be kind of a compare and contrast type approach. You know, from a disclosure standpoint, you know, there's already a conflicts-based, you know, set of principles in effect right now, which addresses a lot of these scenarios. So in some ways, this is more a codification of standard industry practice, especially here in the US anyway. So I question how much, you know, is really going to come out of this in terms of change.
Okay. Sorry, yes. Someone in the audience here in New York. Go ahead, sir.
Obviously, on one end, you want transparency, you want disclosure, you want fair access. On the other way, as you said, costs are going up, so it leads to a consolidation. Won't there be a backslash? Because at a certain point, you want competition. You don't want three or big players to control the market as predators. You want equal access of emerging fund managers. So don't you feel that at a certain point, regulation will have to counterbalance this?
Just for the online audience, to sum up that question, you're saying regulation is going to be needed to counterbalance the costs and competition.
Correct. Currently, what is a consolidation? Cost is going up. Are you killing the emerging fund managers, which you need to create a healthy environment, right?
I think 2 or 3 members of the panel would say yes. And then, so why don't you expand on the point you've made on that, and then maybe Chris will come at the end and try and say no, if that's what you want to say.
Certainly our clients agree with your points. Certainly the group of industry trade associations that are suing the SEC agree, and they have been very publicly saying that that is going to happen, and it's part of the reason why they're making that lawsuit take place. So, you know, we're talking about unintended consequences. I will come back to my reading of Gary Gensler's statements. I don't think they're unintended. I think they're intended.
Can you expand on that for those who aren't that familiar with Gary Gensler's statement?
Yes, so as I mentioned before, he says that these managers make too much money. There are too many of them. He has said publicly he likes the mutual fund industry. There's a handful of really large behemoth organizations. It's easier for them to manage the regulation of those. And he says that they are, you know, systemically risky. The industry is systemically risky. And so I don't think it's unintended. I think it's intended.
Whilst the camera's pointed this way, anyone else on this side of the panel want to add to that before I switch and put the spotlight on Mr. Addy here? No?
I mean, there's clearly an ideological element to all of this. There's no doubt. And so if we're talking about, you know, democratizing, you know, so quote unquote, democratizing the fee structures, right? Driving fees to the lowest common denominator. You know, there's so many elements to this that are ideological that, you know, the capitalist in me just raises a big question mark.
And actually, I'll put this to the lawyers at the table. So there seems to be a shift towards principles as opposed to rules. So to put this in almost a sort of a term that comes back from me from many decades ago, the sort of whenever you dealt with the SEC, it was always the letter of the law. When you dealt with other regulators, it's always the spirit of the law. And that has a cooling effect in some ways on the way you go about doing your things. You tend to be more conservative because the scope isn't so clearly defined. I think I don't know if that's a shift. It's a question. Is that a shift in this space? Are we seeing a shift in US regulation?
I actually view it as the reverse. I think currently we live under a principles-based regime. You have a fiduciary duty, and then you looked at all the facts and circumstances under every scenario. It's always been the case that if our clients were giving different liquidity in a side letter, which we generally would have discouraged anyway, they had to disclose that, right, as a fiduciary matter. Now we're going to a more prescriptive regime where you literally have to tick through material negative effect. Is it required by law, right? You're working through sort of prongs of a rule rather than a holistic view of, is there a fiduciary concern here? Can it be mitigated? What is the effect on the pool and the other investors and the like?
Yes, question here, and then we're going to switch tack a little bit in a minute, but go ahead, sir.
About 10 years ago, the European Union implemented not a wave, but a tsunami of regulation with the AFM. It was seen as something that would destroy the activity and so on. It generated 2 new businesses for consultants active in compliance, but also for other, in Gold Rush, these are probably the ones selling the shovels. So if someone wants to invest in a profitable industry, I guess that combines something. But there are many managers who were facing this situation and believe they couldn't handle it. We estimate that the cost for a fund would be around 10 basis points on a running scale. Do we face a similar situation here? And if so, are there any lessons that we would like to learn from what was implemented in Europe?
Well, I'm going to make an attempt to answer that question by referring to an article in the issue of the NED, our fund governance publication, that I think came out yesterday. We have in it an article which is probably one of the most controversial articles we've ever published in 12 years, which is written by a very prominent Irish-based NED who's retiring. That's why he's been prepared to write it. And he said the whole thing, he's talking about exactly what you're referring to, has been, and this is supporting the point actually that the majority of the panel will be making in a slightly different content. It's been a complete con because they put in these huge structures in Luxembourg and in Ireland, vast numbers of people, professional people are employed. And he says this is a very simplistic overview of a very sophisticated argument, but by and large, it's been an expensive waste of time because the decisions are made by the investment management teams in Chicago, New York, Boston or London. They're not made by all these people doing the oversight in Luxembourg or in Dublin. And the costs of employing all these people in these places for doing basically nothing because of the AIFM directive has been largely a waste of time. But as he says, there's too many people with vested interests in this to have never challenged it before. So I guess, yeah, a bit of a controversial point of view. Rarely do we get that argument made by a participant in the industry, but there is quite a cogent argument to make that case. Since we're on the subject of Europe, perhaps we can, and touching upon managers, perhaps we could switch the angle of this discussion for a while, because as I said earlier, there are a lot of people overseas following this discussion. And I really want to try and find out from everyone, assuming, of course, most of this goes through, or a good chunk of it goes through, which I think we all agree it will. What does this mean for overseas advisors? Because a lot of overseas advisors are, if they're sitting in London or wherever they may be outside the US, they're going to have some connection with the US. They're not going to have the bigger managers all will have some connection. How are they going to distinguish in a commingled structure that may be based in Jersey or in Cayman or wherever it may be? How are you going to distinguish what you have to do for your US clients and for the SEC from what you're doing in the UK or Europe or anywhere else in the world? How's it going to work? Because in theory, it's only for the US, right? But in practice, is that going to be the case? Who wants to take that? Do you want to have a go? Sean?
Sure. Yeah, I think it's yet to be seen. And, we work with a lot of global managers that, are subject to different regulatory regimes. And, the ideal is, hey, I want one compliance manual and set of policies that applies to, MAS requirements in Singapore, FCA, US. And then, I have to spend hours on the phone convincing them that that's a terrible idea because it just doesn't actually work in practice. And they say, oh, I want the highest standard, I want to meet the highest standard and the highest burden. So therefore that's going to be my policy. In practice, it doesn't really work that way. So you have this fragmentation of reporting and different pieces of your business where you really have to put them in silos based on jurisdiction. I don't exactly know how the industry is going to treat this. Now, I think we also see the proliferation of funds of one and getting out of the general pool of investments and just, commingled assets generally are becoming less and less popular, especially as institutional investors are pushing for their own SMAs or whatever it's called. And I'd be interested to see how that actually shapes out and what the impact that is on a global level for negotiating those type of structures and deals and preferential treatment, things like that.
Okay, anybody else want to answer that? There's something I'm going to get on to in a minute. Anyone want to say anything on that? Or so basically, whether you like it or not, if you're in London or Timbuktu or Addis Ababa, unless you are not connected in any shape or form with the United States, which is unlikely, you are going to get caught up in this in one way or another. Is that right, Chris? Do you think?
I think some of the deliverables that will become embedded into the governance, risk and compliance workflow that oversees a portfolio of external asset managers will become normalized and pervasive. So the quarterly statements of performance, which is calculated on both a levered and unlevered basis, coming exactly to the subscription credit line question. Of course, that doesn't apply to hedge because we're already cutting quarterly NAVs. This is applying to private equity, venture, real estate, infra. And I do think about almost probably 90% to 80% or more of the change here is really the private market side of private funds as compared to hedge. Similarly, the same approach around fees. Once we have that granular fee disclosure, which also has to be linked to exactly the term in the offering document that permits that particular fee to be charged. I think once that has been received, that will become the de facto norm. It'll replace the AIMA Allborn expense template for hedge. It'll replace the ILPRA expense template. That will become the standard structure. And you might be a CVC, a Permira, an EQT, or a Han in Korea, wherever it may be, Europe, wherever. You will be providing that type of standard reporting. I think there will be unintended consequences. Super quickly, I mean, the question of subscription credit lines. We signed up for Preqin about a year ago, and loads of information. And I actually asked them, I said, well, how do you split it out so you show the performance of the private equity in all the quartiles so you split out the subline so we can actually see what the true economic performance of the underlying investment policy is. And you can't. It's always presented on a levered basis. So obviously, if you want to be in the top quartile and everybody else is levered, you need to be levered as well with your subline.
Have you seen a reduction in the use of subscription lines of credit now that we're out of the zero interest rate environment?
I was actually chatting with one of the Canadian Maple 8 and their ODD team. And the comment was, do you capture in Castle Hall in financial statements the basis point cost of the subline? And we do capture aggregate expenses and we do capture that. And they said they just got one that was 88 basis points because it was obviously early on, it's in the subscription period. And then the comment was, well, our investment team loves this because it puts the IRR up. I think the real action is on the other end of the spectrum with NAV lines. And again, I do expect ILPA is going to come out, is preparing a paper around the NAV line process that large firms like Vista and Carlyle have been using to borrow to pay distributions, which opens up a separate financial engineering question.
Okay, I'm going to switch slightly the angle of this discussion for a few minutes. You touched upon side letters much earlier on in your comment. I want to ask, what are the implications of these rule changes for fund directors, especially those in international fund jurisdictions? I know there are some fund directors in various parts of the world following this discussion today, and we'll be writing about this in the net as well. What are the, and maybe we can tie this into the point I think you made in your opening comments, Chris, about what goes into side letters and how much of that is going to be, comes up on the board, and what's the responsibilities in simple terms of fund directors for funds caught up in this?
I think what we have is probably 2 or 3 layers. So the first question, if I'm a director of a Cayman fund or I'm a corporate director of an ACD in the UK or a responsible entity in Australia, the first thing I'm going to need to do is, well, what are the side letters for the fund entity itself? Am I aware of them? And if it's a master feeder, if I'm in the Cayman feeder and I've got a Delaware partnership, am I aware of what's happening on the other side? So have I actually been told and informed of everything? The second question is, what happens about parallel vehicles? If there is a fund of one, if there are SMAs, am I aware of what's going on there? And that, I think, starts to become a grey area as to whether I'm aware of different terms that have been created for an essentially parallel fund of one. Fund of one can be in so many structures. I've seen plenty of our clients go to the board and go, we've negotiated a fund of one, and it's actually just a feeder into the master. So it's a dedicated feeder, but it's not providing for any segregation. I think the really interesting one, though, is where it gets much grayer, is holistic arrangements with the asset manager across an investment program. And I've certainly seen numerous instances at the larger end of the spectrum whereby people are invested in 10 different portfolios, funds are participating in multiple co-investment programs, and have a multitude of sophisticated access arrangements that give co-investment rights. The LPs could be bringing assets to actually propose transactions. I'm aware of one large private equity firm. They have a central treasury desk that is able to provide short-term financing to portfolio companies and other elements in the marketplace. That's not in the funds. It's just the principals of the large private equity firm, but certain sovereigns are cut in for a piece of that private action, so to speak. So if I go to Carlyle, I think they have 547 entities, private funds listed on the ADV. The question of, are we aware of all of the things that are happening across these very, very complicated organizations? And is something potentially going to come back to be to have some form of relevance or proximity to the specific entity and strategy and assets that are held within my Cayman vehicle or my other offshore vehicle, Jersey, other jurisdictions, etc.
Anyone else want to talk about the implications for fund directors and international jurisdictions, Philip, as well?
Well, I'll take that in reverse order. I think the jurisdictions that as I said earlier, I think if you're structuring and with cross-border capital flows and structuring in offshore jurisdictions, you need to be looking at jurisdictions, not just how well they can help you today, but how well they'll be able to digest rules and regulations coming. It's an important distinction. But as for the governance side specifically, I think this just means greater expertise is going to be demanded of the people that are actually doing this work. That's a shift. And so that also has implications on jurisdictions. Do you have the depth, the actual talent depth, the human capital depth in that jurisdiction to actually do that work? And there'll be greater, I almost feel like I'm going to say something that probably puts me out on the thin ice here, but I think there was a lot of talking to these issues, particularly after the GFC, that you needed to have greater board diversity, you needed to have and more independence, and you needed to have greater technical expertise, and then it sort of faded off, and then you had what was the lowest, people were bidding on price for directors. I think that's going to be very difficult in this environment. How you actually populate your boards with people that actually understand the transactions, the asset class, the sophistication of these transactions, that I think would change governance.
That's interesting. And to Chris's point, he said, have these directors, been, whether it's in Jersey or Cayman or wherever it may be, have they really been involved in everything that's been going on the board? My suspicion is they haven't. Would you like to comment on that? And will they have to be now?
Well, I don't want to speak for board, other people's boards. I think that you have an industry that's gone through an evolution. The very opening gambit that Chris put on the table was that this industry is different than what it used to be. And so there's this echo, this legacy of people that grew up in an industry when it was a much simpler time. And they're sitting on boards and they actually don't have the expertise in these particular transactions. And I think investors now are going to look through to that and start demanding that people do, because those are really the eyes and the ears on a deal by deal basis. And they need to be able to understand how these are structured so that they know what the implications of these funds.
I'm going to we haven't got long left, but I want to quickly ask to your own point, Chris, before we leave this point. You said, have the directors been, fully informed on what's going on when it comes to side letters, etc.? What's your own guess on that?
I think it's very variable. Certain instances, the directors must be signing side letters. Other instances that can be delegated to the investment manager, but typically that will be reported at board meetings. But of course, to have a board predicates the fact that we have a corporate fund structure, a corporate entity. So that puts all of private equity off the table, as they are all structured as partnerships. So we might have an LPAC, we might have a board of a GP entity, but fundamentally we're already in a different privately negotiated world, which is, again, it's one of the reasons why the SEC has said one of their 3 pillars of weakness or areas of attention is lack of governance. The only other, I like sort of trying to give some examples as we walk through here. There is, again, a trend to take governance more seriously. One of the best examples is in the UK with the firm called Woodford, which was a mutual fund, but blew up basically because of they ran up against limits in illiquid assets, and there were redemptions. The proportion of illiquid assets grew too high. They had a sort of a corporate services administration company called Link, that had bought a smaller firm called Capita. Anyways, they got fined £350 million by the by the FCA. This is now starting to get much more serious when there are clear defaults and negligence in play.
Sean,
I have just one comment that's kind of ancillary but related to this. But I'm actually really interested to see how this changes or impacts the real estate fund community, right? The vast majority of real estate related funds, unless you're investing on the debt side, aren't even registered. So they're not necessarily subject to these rules. Some of them opt into registration because whatever, an institutional LP wants them to or whatnot. But if you have a real estate manager that's investing in substantially the same assets, one's registered, one's not, how is it going to impact that? How are investors going to look at those two? Where are the expectations going to lie? And kind of, again, what's the collateral effect on an entity that's not really registered? If you want to pick an asset or a strategy that knows how to pay themselves really well, real estate, right? You have
benchmarking studies.
It's unbelievable. You have affiliated servicers, brokers, management companies, developers, all under the same roof. So so I mean, if I think the SEC is ignoring a pretty substantial risk if they're by not going after real estate specifically more so.
Excellent. Well, we haven't got long left. I'm going to ask the panel. We talked about Pandora's box earlier. Now I'm going to talk about crystal balls. I'm going to ask everyone to speculate on 2 things. One, what do they think is going to happen? Because someone said earlier, this is quite political. I'm sure they're right. A, from the point of view of litigation. B, as I touched upon briefly, this is probably all going to drag on until whoever is the next incumbent in the White House. So that could be reversed if it goes into the White House, that is, goes into Republican hands. So I want you to speculate on that to begin with. And irrespective of what may or may not happen on that, how do you think this is going to without risking asking you to repeat what you said initially, how is this really going to change the industry, both here in the US, but also, if you wouldn't mind, for the online audience in particular, outside the US? What does this really mean? Is this a fundamental change in the way the alternative fund business has been or will be organized? Who wants to go first? Michael, you haven't said anything for a while. Do you want to?
Again, my opinions are shaped by the activities of our clients. We're observers of business, and I'm blessed to sit in a chair that lets me observe a lot. I'm a fan of the merchant investment advisory regime, the way that it exists. I think rather than and I'm not thinking on my colleague to my left, he said that, you know, the U.S. regulatory regime for private funds lags behind other jurisdictions. I'm thinking on, I happen to think we lead other jurisdictions in the world in terms of creating very strong, vibrant asset management industry. Is why we're the leading jurisdiction in the world for investment talent. You don't have to invest in these funds. He said we don't have to. You choose to. I had a client one time who were his terms. He was fantastic at what he did. He's passed away now. But his investment terms were essentially, I will pay myself what I want when I say so. And he was incredible. And he would take up to 50% of the profits, you know, that he made in his transactions. And the investors loved him. They were fine with that. They thought he was great. He was great. So I'm a fan of it all. Do I think that it's going to change? I do think that it's going to change. I do believe there's an ideological aspect to all of this. In this unfortunate political environment we see ourselves in. There's too much pendulum swinging in the United States. We don't like that as Americans. Our system's not really set up that way. This particular one is swinging too far in one direction. It will come back, whether it's through the courts or it's through a different political regime that's in place. I can't tell you what will change. I can't tell you, when it'll change, but clearly this one is going to negatively impact the greatest industry in the world for what these guys do. And there will be change.
Whilst this attempted camera is down this end, do you guys, Philip, do you want, and then Eileen, do you want to?
Well, you started off giving me the benefit of going last, so I don't get that now. But I'll leave aside sort of thinking of how this will impact. It's going to impact profoundly the way these markets work. And I don't know, I think we've touched on this. I mean, I do think the irony of all of this is that there's greater systemic risk in these industries when you do that. But again, your investor base is very different than what it used to be. The jobs of regulators, the way they see their responsibilities, trying to address that. I think one thing, though, that I wanted to discuss, we didn't put on the table today, is actually the implementation of this set of rules, of these reforms. And we almost describe it as sort of, it's clear. It is really anything but clear. It is full of nuance and ambiguity. And the firms that are already wrestling with the implementation are coming up against this problem. And so the one thing to take away from this is if you were sort of hoping that the regulatory or the legal challenge would in some way prevent having to inculcate these rules into your organization, you are way behind the curve. Right? You need to be wrestling with this right now because there is rife with ambiguity. So that's the one thing I would leave people with.
Okay, Eileen.
So I do think this is going to be a fundamental shift in the industry. I think the real pain point is going to be the relationship and the interaction between investors and managers, where it's often very collaborative now. My concern is that becomes a little more adversarial. And I think that the real losers, unfortunately, in this will be emerging managers, smaller managers, and niche managers, right? The big guys who have been putting up numbers for the last few years and don't have any capacity left in their fund, and good for them, right? Will still have the leverage that they've had. And I don't know that this will change much for them in that dynamic, in that interaction with their investors. But the folks, the managers who don't necessarily have that leverage will be at even more of a disadvantage.
Okay, thank you very much. Should we come to you first of this side, Chris, for and then sorry, the camera is not working.
There we go.
There you go.
I think again we are in a different industry. Ultimately, I think we need to take a moment to think about what institutional investing means. And I think there are two elements to that. The first element, again, is I really come back very, really the central element of my thesis is this is a public market question that is impacting hundreds of millions of people in the Western developed economies as we have an aging demographic. And where we've arrived to in 2023, which is, again, just about 29 years after I first saw the Tiger funds in Bermuda, we now have an industry which is pulled in two directions between the traditional entrepreneurial flexibility of small emerging managers, nimble, capacity-constrained niche strategies that probably, in my mind, have greater operational risk and on occasion do blow up due to fraud and error, etc. Versus managers with the size and scale who can support very large and increasing pools of capital. So if we think about what institutional investing is, we're clearly seeing a trend to be thinking about public policy and looking through to the purpose of capital markets to deliver those outcomes. When I'm thinking about asset managers, I always like to say it's a little bit trite, but an institutional asset manager, first and foremost, is somebody who, if something goes wrong, they're big enough to make you whole. And the best example of that recently is AXA. So who would have thought that AXA's high yield fund could have blown up with an egregious set of essentially amateurish fraud? They had their chief investment officer was simply manipulating risk reports. It said 42.4%. The guy changed the spreadsheet and put it at 4.24%. Almost laughable in its naive simplicity. But this was AXA. $5 billion had to be paid out to AXA's investors, and they were ultimately made whole. So it's really a push and pull in institutional land. Where are we on the spectrum of whose money is it? What is the right size and scale of manager? Again, I personally believe that we'd be better having two categories of industry, one which is private markets, private wealth, ultra high net worth, etc., and the other which is essentially an expansion of ERISA. Almost, we could almost sort of simplistically take that. Again, I'm not an attorney to understand the details of exactly the implementation, but conceptually that type of division. But as we can't do that, and we're all bundled into one, in 2023 going to 2033, this is pensioners' money. That's now the majority. So that's the direction we're going to be going in.
Sean, final word with you.
Yeah, I think overall the U.S. private fund industry is very resilient. So I think it'll figure out a way. I tend to think that reactions are usually a bit more overblown than they need to be, and I think we'll figure it out. I think there will be innovation within the industry, service providers and whatnot, who will come up with pragmatic and cost-effective solutions to deal with some of the more onerous regulations. By the way, point of clarification, when I said the U.S. regulations lag, I just meant in terms of level of onerous, not necessarily effectiveness.
Not picking it.
Yeah. We're on the same page. But on one end of the spectrum, there could be massive consolidation, right? It's all the large mega funds, funding dries up for lower and lower middle market companies. That's the kind of draconian reaction that I don't think is actually going to happen. But I think it will change the industry. I think probably what will happen is something that we have no idea, right? It could be a states' rights issue where, kind of using ESG as a parallel, right? DOL said, hey, you can take into consideration ESG when making investments. Now, all of a sudden, you have states like Alabama and Mississippi saying, no, you actually can't do that. So then you have, state and federal laws conflicting, and what happens? You have stalemate and nothing actually happens. And that tends to be the preferred outcome with all things political in the U.S. And, at the end of the day, we basically achieve the status quo with minor changes. My assumption, but who knows?
Well, thank you all very, very much. Both of you, both sets of you who are online, who are still there. Thank you very much. And those of you who are still here in the room, thanks very much for joining us. As I said earlier, there will be a recording of this, probably go up sometime next week, and we will be publishing an article on it too. Hopefully see you back in New York in person or online sometime next year. Those of you in the room, I hope there may be some breakfast left, so please do stay and consume that. It's there to be consumed if you can. And online, have a good morning, afternoon, or evening, no matter where you are in the world, and see you the next time. Goodbye, everybody. Oh, and thanks again to Jersey Finance and to our fantastic panel. My only regret is they were far too polite with each other and there were no punch-ups. But hopefully we'll get that the next time. Bye-bye, everybody.